morning, everyone. It's December 20th. I am John Greathouse, and we're going to talk a little bit about my Halliburton covered call. Back on December 6th, I did a video on writing a covered call on Halliburton, and I wrote 10 contracts for a $45 strike. I think I got 94 cents for that. So picked up $940, and I went ahead and did the February 18th date expiration just to put it out there a bit. Halliburton was rallying at the time, so I was able to get a good price. Well, fast forward, and one of the things I talked about in the video was if Halliburton got down to about 20 cents, if that same option that I sold for 94 cents came back down to about 20 cents, I was going to buy it back. And here we are. It's December 20th. Well, it's a Saturday. Markets are closed. But on Friday, I went ahead and I bought that option back. Now, I paid 18 cents, and I paid a little bit too much. And I'll quickly explain the mistake I made. But let's talk about the trade real quick. So if you go to my channel, you're going to see that I wrote that covered call, picked up $940, said, hey, if it comes down, I was going to go ahead and buy the call back. I was going to write another covered call on Halliburton. What we had was back, here's December, I want to say right here, somewhere in here, Halliburton starts to get a move. And the options were looking good. I'm saying to myself, okay, if I write a call here, I'm in the red on Halliburton, okay? I think I said in the video that I tried to play Halliburton up, made a little bit of money. As it was coming back down right here, I thought I would catch that to the next run. I didn't. The rest of oil fell, feeling that pain right there, and here I am, stuck with Halliburton. So let's write some covered calls to get out of this problem. So that's what I did. So somewhere in here, and I don't have the exact date, it was December 6th, wrote the covered call, picked up 94 cents, and here we are. Fast forward. Halliburton has tailed off for a couple reasons, okay? Notice $33. So look, I'm holding Halliburton. You know, in my mind, Halliburton is not like the other oil companies where they're highly leveraged, you know, highly under pressure right now by the debt agencies to lower their dividend. You know, we just have a glut of oil, and when you have a glut of oil, companies, oil service companies like Halliburton, maybe they don't have as much business. It's not to say they're going out of business. So with that said, I'm going to feel the pain. And also the Baker Hughes news. It just hasn't come. And there's a thought that, geez, it just may not happen. So it fell off. And here we are. You know, here we are down here. So I'm at 33. You know, again, the call option got down to about 18 cents. And I bought it back. So right now I'm clean. I own the shares. I was going to own the shares. I wasn't selling the shares. Okay. So it's fall off from here. You know, critics will tell, hey, oh, you should have, you know, sold the shares. You know, now you're down. Yeah. Well, I'm down. This is where I'm at. And without just straight out selling and taking the loss, I got to work it. So this is what I'm doing. I'm writing covered calls. Out of the money covered calls. Okay. So with that said, let's get back to the deal here. So it rallied up. I got the nice price. It's fallen off. It's now, I bought it back for 18 cents, okay? And right now, God, I should have waited. That same call is 10 cents. So for me, I lost out a little bit of money, probably, you know, took it too early. But where I'm at right now is I bought it back. And instead of making $940 on this covered call, I made about $750 and change, whatever it was. But really, the lesson here is twofold. One, you know, we want to write covered calls where possible to recoup some of our dollar cost average. Okay, so I'm in this stock. I'm hurting. I wrote a covered call December 6th. That money that came into the account now can go back to the dollar cost average of Halliburton. Okay, it lowers my cost. Okay, I'll write another one. okay? And hopefully we can start to lower our loss, okay? Second, and I'll be real brief on this because I can get deep into this, but just with stocks, you can do a market order or limit order for anything. You could buy at market, boom, it buys it, or you could buy at limit so you can get your price. Well, on Friday, the last trade on that option was 14 cents, but the ask was 30 cents. And I said, man, I think the bid was 14 cents. So I'm going to buy to close. So I'm going to pay the higher price. So I went in with a limit order for 18 cents because that's what I wanted. And immediately it closed. I knew I jumped too early. Little lesson, if you're going to do limit orders and you're not panicked out of the stock, look at that last trade and put it in. I should have put that last trade in for 14 cents. I didn't. I put in for 18 cents. Had I put in for 14 cents and maybe waited 5 minutes, 10 minutes, I'd have got 14 cents. A little bit more money in my pocket. Okay? So I put in for 18, immediately went. Look at today. That same option's 10 cents. Not saying I'd have gotten 10 cents, but the point is, when you do the limit order, put it in for that last trade. Just see if you get it. If not, inch it up, then it gets taken. Okay? So there's a lot to learn with covered calls, guys, but here's the deal. At the end of the day, you can make a great monthly income on this great strategy of writing covered calls against your stocks or buy right covered calls. Okay? It's that side of Wall Street that nobody talks about, or when they do talk about it, it's very misunderstood. Look, I'm going to generate thousands of dollars this year, knock on wood, in covered call writing. Okay? We're going to learn along the way. Keep watching my videos. I'll keep talking to you, telling you straight how it is. And I think we make some money. Hey, I hope all your covered calls are profitable. Have a good day.